In this video, we are going to have a look at the rationales for costing. So firstly then, we will have a look at what the actual definition of management accounting is. So this is the application of the principles of accounting and financial management to create, protect, preserve, and increase value for stakeholders of both not-for-profit businesses as well as those for-profit enterprises in the public and private sectors. So within this, you need to be aware of what cost accounting is as well. So this is a subset of management accounting, and it is focused more upon calculating the costs of a product or service. Their techniques are designed to provide financial information about an organisation performance, which will include both controlling and managing the costs involved. With cost accounting, the focus tends to be more towards short-term improvements and decisions. So the official definition for cost accounting is as follows. So it is the gathering of cost information and its attachment to cost objects, the establishment of budgets, standard costs and actual costs of operations, processes, activities or products, and the analysis of variances, profitability or the social use of funds. So cost accounting is more useful for operational and tactical decisions as opposed to strategic decisions, which will be found at the very top. So we are going to have a look at what we mean then by operational decisions. So these are decisions which will be made by the lower level managers and will focus on the day-to-day management and running of the business. So this could be things like setting your daily tasks for staff, or it could be working out how much raw materials actually does the business need. Tactical decisions then, this is going to involve your middle level managers. It is going to be medium term, and examples of your tactical decisions to be made are going to be things like, how do you train your staff? How can we recruit staff? How many staff need to be recruited? And also, how much are we going to pay for any new machinery or upgrades to machinery that may be needed? So, strategic decisions then. This is going to be at the highest level of management. And it's going to be the biggest decisions that an organisation is going to make. So things like the acquisition of another company, perhaps the idea of a merger, or it could be more simple, such as a new product launch, or perhaps just the opportunity to expand the existing business. So types of data cost versus management accounting then. So we've got cost accounting. This is mainly going to be on quantitative data, and it is data that can be measured. So examples include how much does raw materials cost, or perhaps how many labour hours are required. Management accounting, on the other side, delves a little bit deeper. So yes, it's going to include quantitative data, but it will also include qualitative data. It is harder to measure and it's harder to quantify. So examples here then are going to include your customer satisfaction levels, your employee satisfaction levels, and also staff retention rates. So just to note then, although we're looking at management accounting, we're just going to have a quick look at the definition for financial accounting. So this is the classification and recording of the monetary transactions of an entity in accordance with established concepts, principles, accounting standards, and legal requirements and their presentation by means of the statements of profit or loss, the statements of financial position, and any statement of cash flow during and at the end of any accounting period. So financial versus management accounting then, both two very different concepts. So let's take a look at some of the key differences here. So financial accounting then is external. It is required by law. It is based on historic data. It is needed in order to actually produce and publicise the statutory accounts made necessary by HMRC guidance, and it is governed by rules and regulations, such as the International Accounting Standards and the International Financial Reporting Standards. On the other hand, we have management accounting. So management accounting will be solely used for internal purposes in order to help managers make their decisions. It will not just focus solely on historic costs, although it will take those into account. It will also look and predict into the future. And it can be produced in any format. There is no set guidance on how this must be done. So with management accounting then, there are three main purposes as to why a business would use this. So we have planning, control, and decision making. So looking at the first point then of planning. So at this stage, we would establish any objectives and goals of an organisation. So what exactly do we want to be achieved, and what strategies can we put in place, or what strategies have been put in place previously which may assist us with that? How can our goals possibly be achieved? And the management accountant creates budgets to explain any potential what-ifs. So financial plans for what happens with different assumptions. Not everything is going to go to plan. We then move into the control phase. So this is all about monitoring, measuring, evaluating, and correcting actual results, ensuring that budgets can be achieved. So in this phase then, the budget will be compared to the actual at the end of each period. So it is very important that managers and management accountants take into effect variance control and variance analysis here. By doing that, managers are able to identify if any measures need to be taken to get back under control. And the third part then is decision making. So this considers any information which has not yet been provided. It involves making a choice, as the name suggests. In order for this to be effective, though, managers must be given reliable, comparable information to accurately weigh up all pros and all cons. So CIMA has a set guideline for what a management accountant's role actually is. Now, it is quite lengthy, so let's have a quick look at the main points here. So formulation of policies and setting of corporate objectives, formulation of strategic plans derived from corporate objectives, formulation of shorter-term operational plans, the acquisition and use of finance, any design of systems, recording of events and transactions and management of information systems, and the generation, communication and interpretation of financial and operating information, such as product costs, so for management and for other stakeholders. Provision of specific information and analysis on which decisions are based, and the monitoring of outcomes against plans and other benchmarks, and the initiation of responsive action for performance improvement. Any derivation of performance measures and benchmarks, financial and non-financial, quantitative and qualitative, for monitoring and control purposes, and the improvement of business systems and processes through risk management and internal audit review. So the word cost is something that we use a lot, not just in our accounting studies, but also in our day-to-day lives. So if I had to define it, there are two ways in which I can do that. I can either define it as a noun, which refers to the cost of an item, or I can define it as being a verb, which basically is an attempt to cost an activity or perhaps undertake the tasks necessary to determine the costs of carrying out an activity. Costing definitions then. So we have cost units. So this is a unit of product or service in relation to which costs are ascertained. We then have our cost centres, which is either a production or service location, a function, an activity, or an item of equipment for which costs are accumulated. Cost objects. So this, for example, could be a product, a service, a centre, an activity, a customer, or a distribution channel in relation to which costs are ascertained. Cost classifications then. So we can classify cost by their behaviour, by their element, by their function, or by their nature. So we are going to have a look at each one of these in turn. So costs according to behaviour then. Well, the first way we do this is by referring to those as a fixed cost. So these are costs which do not change in total as the activity level changes. They are essentially costs that do not change with the level of output. Variable costs. So these are costs which do change in total in direct proportion to changes in an activity level. And then we have our semi-variable costs, which basically have an element of both a fixed cost and a variable cost to them. If you are working out a semi-variable cost, you will need to use what we refer to as the high-low method in order to calculate the fixed element as well as the variable element. So, like I've just said, it is used to analyse the semi-variable costs into each element. We can work out our variable cost per unit by working out our increase in cost and dividing that by our increase in activity level. Costs according to element then. So first up we have materials. So this is going to be any components bought in by a company which are used in manufacturing a product. Do be careful because this will include the cost of obtaining the material and actually receiving them into an organisation. We then have our labour costs. So this is costs of people working for the organisation. So anything like sales, salaries, sales commission, salaries, overtime, wages. We then have our expense account, which are regularly incurred costs of a business. So this is things like rent, insurance, telephone, electricity bills, etc. Costs according to function then. So it could be production. So these costs relate directly to the manufacture of a product or provision or service. So this could be your prime costs, your direct expenses, production overheads, etc. Alternatively, it could be non-production. So these support the overall activity of an organisation. So this is going to be your admin costs, selling and distribution, and finance, etc. Costs according to nature then, we simply split up into direct costs and indirect costs. Our direct costs are going to be directly traceable to our cost objects, whilst our indirect costs cannot be directly traced to a single cost object. And the final thing to be aware of when we are looking at this is to be aware of the cost transformation model, which consists of 6 key elements. So the first one, creating a cost-conscious culture. So management accountants should essentially aim for their business to be a cost leader. They should aim for lower costs than any of their competitors if they want to set a competitive benchmark. So this includes ensuring that they have a motivated workforce in order to reduce their costs. They should also aim to utilise technology to its fullest. The second part of this is to understand cost drivers. So we need to investigate costs to consider any variables. There should be a critical evaluation completed of any current systems in place, and there should be plans put in place to reduce drivers of costs. Managing the risks that come from a cost-conscious culture is also important. So a company must weigh up any pros and cons, and they must clear risk management process in place to identify, assess, and manage risk as they arise so they can be dealt with effectively and efficiently. Connecting products with profitability then. So this is about having a positive contribution to overall organizational profits, as well as understanding what actually drives the cost for each product, as well as being able to allocate shared costs correctly and appropriately. Maximizing value from new products. So this has the potential profitability of new products being assessed prior to production. And it will appeal to as many customer segments as possible. The more customer segments that a business can target, the better their profit is going to be, lowering their overall cost. And the final part of this model aims for management accountants to consider the environmental impact of products. So negative impacts such as unnecessary waste can add costs as well as damaging reputation and sales. There is a big thing at the moment about sustainability and business ethics. A lot of customers may well go to a competitor who is acting in line with the sustainability policies at the moment, as it is becoming bigger than ever. So if a business can reduce their carbon footprint, it is highly, highly recommended that they do so.